This is the fourth quarter update for the Amplify CWP Enhanced Dividend Income ETF, symbol DIVO. Joining me is Kevin Simpson, portfolio manager of the ETF. Kevin, let's start at a high level. Could you please remind viewers what is the investment thesis and strategy behind DIVO?
Absolutely, Jay. And this is the year of DIVO. We're looking to invest in 25 to 30 best of breed, high quality, blue chip stocks. And for the past few years, we've been overwhelmed with meme stocks and companies with high multiples, and practically could throw a dart and anything would go up. The landscape is changing. And when we look and identify even deeper into the DIVO portfolio, it's not just best of breed blue chip stocks, Jay. It's a dividend component that is just so important. I think even the secret sauce behind the ETF moving forward. We're selecting companies that have histories of increasing their dividends. I look at the recency, so we're really going back 5 years. We want these companies to have a 10 to 15% dividend growth, not necessarily aristocrats or dividend kings. Who cares what they did 150 years ago? We're looking at isolating a 5-year window, and these are all companies that are increasing their dividends because they're increasing their earnings. And that's a really important distinction, because any company can raise a dividend. We want to make sure that they're increasing their earnings to be able to support that dividend growth. And I think really that's the secret sauce behind the ETF moving forward. We're really in a landscape and a dynamic market that's changed. A Fed tightening environment is much different than a quantitative easing zero interest rate environment, and profitability matters today more than ever before.
Could you speak to the covered call component of this strategy?
Yeah, Jay, we look to tactically write covered calls. And over the past few years and periods of lower volatility and rising markets, we've been almost frugal with the covered call writing. And just like we're talking about the landscape changing for profitability and quality companies, what comes hand in hand with Fed tightening and a new dynamic to the market is increased volatility. And that's that increasing volatility that will allow us to harvest more premiums on the covered call side of things. So I expect that in this quarter and this year and for the foreseeable future, we're going to be more active in our covered call writing. It's going to help us to harvest volatility, smooth out the ride. And when down markets happen, which they will and they do, it helps us protect that downside, reduce that downside capture. So as important as rising dividends are, and I think, just take the eyeball test from an inflationary standpoint. I mean, go to the supermarket, go to the gas station, it's real. We're looking at that rising dividend as a combatant against inflation, and the covered calls go hand in hand in it. They work best when we need them to most. And this is the year of DIVO.
So when you look at the holdings in the portfolio, we're recording this at the beginning of the first quarter. Are there any names that really stand out to you as you look forward to the rest of the year?
Well, Jay, we trimmed Microsoft and Apple at the beginning of the year, which was very fortuitous because we've seen markets really pulling back. It seems like there's just a completely different landscape here since January 1st. The 10-year started at 1.51. Today, as we film this, it's over 1.8. Lends itself well to financials longer term. Well, we've seen the earnings coming in a little bit light, a little bit weaker in terms of forecasting because their trade revenues are probably going to be lower. So we've seen some weakness in the financials, especially Goldman Sachs and JP Morgan, which we own. If anything, you talk about buying the dips in the past, which is a strategy that we agree with in terms of high quality companies. These are really, really good, rock solid companies that I would expect us to add to. But in this world, it's going to be about consumer staples continuing to lead the way. The boring old-fashioned names. I'm excited about McDonald's. It doesn't matter if there's hyperinflation or no inflation. Everybody loves a hot order of fries, Jay. So if you look across the landscape of the portfolio, whether it's Pepsi or Chevron or McDonald's, I just think it's a question of now, I've used the term twice, and here I am a third time. Profitability matters, and it didn't in the past. It didn't in the wake of zero interest rates environments and free money and everything else. This is totally different, and it's really, really important to look under the hood. And I just love it. I love every company we have in there. It's going to be volatility, and that's okay. But we're going to continue to amass these great companies. We're going to continue to collect dividends. We're going to write covered calls. We're going to get paid while we wait for better times. But so far, the years come out of the gate a lot different than 2021. Just look at any of the economic reports that we can point to. The jobs report was weak. I know the unemployment number was pretty strong, but still that could be a little suspect. Then we had CPI, highest inflation since 1982. Jay, you weren't even born in 1982. I was watching ET with my brother at the movie theater. You were still in diapers, if anything. Then we had the PPI come out. It was 9.7. And we were celebrating because it wasn't a double-digit 10% number. Then last week we had consumer sentiment that was down. Today we had the Empire State showing that business sentiment is down. Same thing will show this week later for the Philly Fed. Retail sales for December for holiday seasons were down 1.9%. So inflation is real. Interest rates are going up. The market can't stop it. Someone moved your cheese. We're in the right place. We're the right time. And I think when you look at the portfolio, you've got to have tremendous confidence, because here's the thing. Even in inflation and higher interest rates, companies, fantastic US companies with moats and just very, very loyal customer bases can make money. So we're not fearful of higher interest rates. We're not fearful of inflation. We have pricing power. Nike, Pepsi, McDonald's, Walmart. Now, we don't want hyperinflation. We don't want high interest rates. But right now, we're at a point where this inflation is peaking. And I think when we do our call next quarter, we'll start to see a little bit of the crack in that armor, which is a good thing.
So, Kevin, given all that, what are your thoughts on allocations to energy in this market?
Well, there have been times that you and I have done calls with Chevron being a name that you don't want to talk about, like Voldemort, for those Harry Potter fans out there. But Chevron has been such an unbelievable just juggernaut. We also own Marathon Petroleum. The price of oil is back up $85. It's going to go to $100. I mean, who would believe it? Remember, it went from 130 down to 29. And, certainly those stock prices suffered quite a bit. So it's leading the charge. We're super pleased to have it in the portfolio. But that's one of the best things about DIVO is it's a rules-based strategy from start to finish, how we invest in companies, how we allocate, because we're going to own Chevron. We're happy about it now, but we also owned it, when that price of oil went down $100. The neat thing about it is we could write calls on it, and it certainly wasn't getting called. And that dividend also rock solid, paid every time. So we were generating some really strong cash flow. DIVO is diversified and inclusive of all sectors. Some are going to always be outperforming over others. We talk about staples and cyclicals being probably a little bit more in vogue right now. Certainly energy is. And I think ultimately financials will be, even though they're dragged right now, this recording, just an incredible opportunity for these companies to really show what they can do when it matters.
Kevin, for financial advisors building diversified portfolios for clients, where does DIVO fit in your opinion?
Yeah, Jay, that's a great question. For me, it's always a core holding. It's an equity income, large cap play. A little bit more value than growth, but it has a little growth element to it with Microsoft and Apple and Nike and Visa. But the rising dividend theme, each one of those companies, even though those four might not be names that you think of when you're conjuring up dividends in your sleep, but all of them have rising dividends. All of them have increasing earnings. So if you look at this as a core piece of the puzzle, in days gone by, maybe we had a 60-40 allocation from a financial planning just starting point. And now with interest rates having gone down for 32 years in a row, longer than you've been alive, we have zero interest rate environment. You can't get money out of bonds. So maybe that 60-40 becomes 65-35, or maybe even 70-30, depending upon a client's risk tolerance. So we work with financial advisors around the country, really trying to position this as that large cap core holding that can bleed into an income component for clients to take income. DIVO pays monthly. And it's paid almost 5% since inception for 5 years. It's a very, very solid way of thinking about stocks as an income stream. However, there's a difference from a risk profile. It's not your mom's or your grandmom's CD. It's a stock, even though they're blue chip, high quality stocks, and I can sing their praises, they go up and down, and you have to realize that there's a different risk profile with an equity income portfolio than insured CD. So it's not an apples to apples comparison. But certainly we have advisors all over the country that are using this for their clients for income. And for those that don't, I bet you they're just thinking like, well, the neat thing is I can reinvest these dividends every month. And if I need to take the income, I can turn it on at some point. And that's what excites me.
To learn more about the DIVO ETF, please visit divoetf.com. That's DIVO ETF.com. And to learn more about the Amplify ETF's suite of funds, please visit amplifyetfs.com. That's amplifyetfs.com. Kevin, thank you so much for your time.
Thank you, Jay. Happy New Year.